Bob is a wizard. He does magic. Now, if you ask Bob about this, then of course he's going to deny it. He claims he's a manager at a car production plant, and he says he actually hates magicians, and one came to his table once at his daughter's wedding, and he had to get up and go to the bar. But he would say that, wouldn't he? What I'm going to show you here today is some of his magic. Hi, I'm Eric from Time to Retire. Now, if you're like Bob and earning around £75,000 a year in the UK, well, congratulations, you've done incredibly well. You are in the top tier of UK earners. But if you're in the final 5 to 10 years of your career, that 75 grand salary is leaking cash at a terrifying rate. Every single pound you earn above £50,000 is hit by a 40% income tax rate plus national insurance. You're grinding through the most stressful years of your career, yet nearly half of your hard-earned cash is top-sliced and vanished before it even reaches your bank accounts. Well, what if, like Bob, you could choose to not pay it? What if you could legally, safely, and ethically lower your taxable earnings from 75 grand all the way down to 35, keep that missing 40 grand for yourself, and use the taxman's own rules to double your retirement pot in record time? So today we're looking at Bob's ultimate pre-retirement strategy. It's called Earn Less to Save More. And what I'm going to do is I'm going to break down how dropping your taxable footprint from 40% to 20% paid during your retirement years, and how salary sacrifice works, and the plan that transforms a heavy tax bill into financial freedom. Now, before we fix the leak, we have to understand exactly where the water's coming from. Now, in the UK, the first 12,570 you earn is completely tax-free. From there, up to around 50,000, you pay a very reasonable 20% basic rate. But the moment your salary crosses that 50,000 threshold, you enter the danger zone. Now, from this 50,000 up to 75,000, you're paying 40% income tax. On top of that block of £24,700 alone, you lose nearly 10 grand straight to income tax, plus another 2% to national insurance. So the total between your income tax and your NI across your entire salary is sacrificing £21,400 a year to the taxman. This is money you're never going to see again, completely wiped off your personal balance sheet. Now, let's have a look at Bob's magic trick. Instead of taking that top £40,000 as cash, paying higher rate tax on it, and trying to save what's left, he made a pretty radical choice. He decided to reduce his taxable earnings down to 35 grand by shifting 40 grand directly into his pension. Under the current UK rules, the standard annual allowance lets you contribute up to 60 grand a year into your pension tax-free. That's as long as it doesn't exceed your total relevant earnings. So putting 40 grand away is fully within the rules. Now, you can do this a couple of ways. You can either instruct your employer to adjust your workplace salary sacrifice scheme, or you can make personal contributions directly into a self-invested personal pension, SIP, and then claiming the higher rate relief back on a self-assessment if needed. By doing this, you instantly change your financial identity in the eyes of HMRC. As far as the taxman's concerned, you no longer earn 75 grand, you earn 35 grand, and that completely reshapes your numbers. Now, workplace pension is generally the option to go for here, as this will also reduce your NI contributions. It may even see your employer throwing in some extra cash as well, because they'll be making a saving on their part of the NI tax bill. But not every employer is this flexible, and they may lock you into a set percentage of your pay. Now, this is where the SIP comes in. You get the money from your employer into your bank account after you've paid tax on it. Then you transfer it from your bank account into your SIP account. A few weeks later, magically, HMRC do their bit and pay the tax back into your SIP. Now, if you'd paid 20% on your salary earnings before it was paid to you, then they top it back up with 25% contribution. Now, that's not magic. That's just how the maths work for pre and post tax changes. Now, for the cash you move that you paid 40% of tax on, then you'll be given your extra back when you put in your tax return at the end of the year. Now, if you don't know where to start with a SIP, email me on eric@timetoretire.co.uk and I'll send you a simple to follow instruction on how to set one up. Let's look at Bob's magic on his scoreboard. When you leave your salary at 75 grand, your total tax and national insurance bill is over £21,000. But when you drop your taxable earnings to 35 grand, your tax bill drops to just 4,486. You've just suspended £16,936 from leaking out to the taxman. Now look at what happens to your cash flow. Your take-home cash drops from 53 grand down to 30,500. That's a reduction of £23,000 in your pocket today. But look at what you bought with the 23,000 grand drop. A massive £40,000 sitting safely in your personal retirement pot. You sacrificed 23 grand of immediate spending and the taxman effectively handed you an extra £17,000 to boost your pension up to 40 grand. That is an instant guaranteed 73% return on your money. Now, when you retire, you're likely to be taxed on the pension you draw, but for most people, they'll get 25% completely tax-free, and the rest is likely to only be taxed at 20%. Now, the obvious question you're going to ask me is, how am I supposed to survive on £30,000 of take-home cash when I'm used to 53,000? Well, the answer is that this phase is your pre-retirement dry run. Now, if you're, say, 5 years away from your retirement, this is the time to aggressively shed your working costs. Now, if your mortgage is almost paid off, or if your children finally grown up and left home, your household outgoings have already fallen quite a bit. You don't need to sustain a £75,000 lifestyle anymore. By forcing your take-home cash down to 30,000 today, you're proving to yourself that your baseline retirement costs are manageable. You're testing your retirement budget while you still have the safety net of a major salary. Now, if it feels too tight, you can easily tweak the dial next year and contribute 30 grand instead of 40. But if it feels comfortable, you've successfully downshifted your lifestyle early, stress-free. Now let's look at what this looks like if you maintain this strategy for just 5 years before you retire. By redirecting £40,000 a year, you dump a staggering £200,000 into your pension pot in 5 years. Because that money's sheltered inside the tax wrapper, it compounds over those years without any capital gains or dividend tax slowing it down. And when you finally choose to actually cross the finish line and retire, then that extra £200,000 will completely transform your retirement options. It unlocks that 25% tax-free lump sum we talk about so much on this channel. And it also provides a steady, safe income stream that will hopefully last you for a good proportion of your retirement life. Now, you didn't do this by working harder. You didn't do it by taking a second job. You did it by simply refusing to play the higher rate tax game, earning less on paper, but supercharging your savings. The smartest way to prepare for retirement isn't just saving what's left at the end of the month. It's stopping the tax leak at source, shifting your income from higher rate bracket into your pension. It's going to be the ultimate pre-retirement cheat. Now, I'm no financial advisor. My channel's here just for education purposes. But if you do want to know more about how to set up a salary sacrifice scheme or how to claim back your higher rate tax relief via self-assessment, make sure to subscribe to the channel, leave a comment below, and I'll see you in the next video.